One of the biggest factors behind Australia's booming housing market is cheap money, and it's fixed mortgages funding many of the purchases.
Historically, about 85% of people stay on floating rates or variable rate mortgages, but that's flipped. And you're getting as much as 50 or so % of people fixing their mortgages.
Unusually, many of the lowest rates in the market are fixed rates, and not just 1 or 2 year honeymoon rates, but 3 or 4 year terms, including some from the major banks. In fact, 4 year fixed rates at the major banks are cheaper than their discounted variable rates, and that's almost unheard of.
I don't know that we've hit the bottom yet, particularly for those shorter term fixed rates. We could see 1 or 2 lenders inch slightly lower in order to trump their competitor.
Martin Wetton is in charge of predicting where interest rates might go for the nation's largest mortgage lender.
Probably the low was seen a few months ago, and I think from here we do see some banks start to lift their fixed rates, although there's a lot of competition in the market for mortgages.
From a personal perspective, just how confident are you the low in rates is in?
Well, I fixed my rates at the end of last year, not all of it, I never do 100% or zero.
Last month, CommBank raised its 4-year fixed mortgage rate by 20 basis points. And it's not alone. According to Rate City's figures, over the past month or so, more lenders have raised their 4-year rates than cut them. Rate City Research Director Sally Tyndall believes 3-year fixed rates will also start rising later this year.
The term funding facility is finishing on the 30th of June of this year. That will make it slightly more difficult for banks to source ultra low funding for up to 3 years.
The Term Funding Facility is a Reserve Bank program lending out up to $200 billion to Australian banks for 3 years at the cash rate, currently sitting at just 0.1%.
In and of itself, it doesn't mean that they go and borrow there and lend. However, it's reduced the cost of banks borrowing, so it's allowed them to have pretty good fixed rates.
The Reserve Bank's also pushed fixed rates lower by pinning the 3-year federal government bond rate to 0.1%, a program called Yield Curve Control.
And certainly market pricing today is suggesting that they won't extend that yield curve control program. And with that in mind, fixed rates, the pressure will be on them to rise, because this is the part of the curve that fixed rates are really priced off.
Most experts agree the full impact from this will be felt later in the year.
And we think that at the later half of the year, really the final quarter, is when the banks need to go back to the markets a bit more vigorously and borrow, and so they're not getting that lower rate from the RBA. They're actually, I guess, competing for funds in the global capital markets.
But before you rush out to fix your mortgage, there's a few things to bear in mind. While Australian fixed interest rates are at a record low, there are even lower interest rates in other parts of the world, like Europe.
The ECB owns a much larger proportion of bank debt than the RBA does of our locals, and fixed mortgage rates there are as low as 50 basis points.
Economist David Llewellyn-Smith is not saying interest rates will go lower, but that they might. And that could happen if the economic recovery stalls and the RBA restarts its term funding facility, giving low-cost loans to the banks.
These things, once they're in the market, are quite difficult to unwind permanently.
Aside from the chance of rates falling even further, Sally Tyndall says fixed loans offer limited flexibility if your circumstances change.
They have typically no offset accounts. They have caps on how many extra repayments you can make, and if you want to get out early, you could be up for some costly break fees.
But mortgage rates below 2% for the next 3 or 4 years are proving an irresistible attraction for many, while they last.
Michael Yander reporting. In March, lender Aussie lodged about $3 billion worth of home loan applications. It expects to settle $10 billion worth of loans in the first 6 months of this year amid unprecedented demand. I spoke to Chief Executive Officer James Simond. James, have fixed rates reached their bottom?
You know, Rachel, I think fixed rates have always been very flexible in terms of, you know, some weeks they're a little higher than others, some months they're a little lower than others. We've seen a trend of fixed rates going up slightly in the short term, but over the next 3 and 6 months, they may just as well go down slightly as well.
What's been the uptake of mortgage holders with you switching from variable to fixed home loans?
Sure, I mean, today versus somewhere like 12 and 18 months ago, we have more than double our customers who are choosing a fixed rate rather than a variable rate and locking into that security over a 2 to 5 year period.
We've seen house prices rise at their fastest pace in 3 decades. Do you see that kind of growth continuing?
You know, at the moment, we don't see an end to house prices rising. Sure, APRA could get involved and top and tail it and curb the lending a bit. Sure, we could see something absolutely out of the blue, like a COVID type situation. However, house prices are very strong, and in fact they may get even stronger as migration comes in, as the borders are lifted, as university students come back to Australia, as investors come into the marketplace. With more competition, house prices are actually likely to rise even more.
Interesting that you touch on migration there. Does it surprise you that we've seen this level of growth despite no migration for the past year?
You know, Australia is a country in which whenever there are tougher times or economically tougher times, Australians go for bricks and mortar. America may have Wall Street, Australia has real estate. So it's not surprising at all with the amount of monies in which Australians have saved over the last 12 and 18 months. Putting that into blue chip residential real estate is something that Australians have done for a very long time.
Do you think we need to see the regulator step in now with the growth that we've seen in house prices?
I mean, certainly we've seen significant growth in house prices, in particular the last 6 months. I mean, in some areas it's quite incredible. You know, the market forces will be what they will be, and certainly APRA and the like are watching the market, monitoring the market on a daily basis, and they will step in if they feel it's appropriate to step in. Outside of that, I think that the commercial reality is you let the markets play out as they do.
So you're not concerned at the rapid rate of growth we've seen?
You know what? I think that everyone is a little concerned with the rapid rate of growth over the next 3 and 6 months. If we're still seeing that sort of rapid rate of growth, I think that, you know, APRA and the like will probably step in.
What way do you think the market would need to be tempered if we do indeed see growth continue at this rapid pace? Traditionally, we've seen, or historically, I guess, we've seen that tempering with investor loans, but we're not seeing so much investment at the moment. It's first home buyers. Has there been too much advantage for that sector of the market?
And I think that's why APRA really hasn't stepped in as yet, because it's very much an owner-occupied led growth, very much a first home buyer led growth. Investors really haven't been a big part of the market yet. But if investors come in, when investors start coming in stronger and stronger, which they will, then the likes of APRA will take a closer look, and then they may actually put some top and tail in the marketplace. Most likely they will actually, from a lending point of view, ensure that a greater deposit is needed, so the loan to value ratio is less.
Aussie is in recruitment mode to try to hire enough brokers to fulfil this increasing demand that we're seeing nationwide. And I understand you're hiring people not necessarily with a finance background. Is that the best idea, considering these unusual circumstances the property market is in?
Rachel, March last year, we launched an aggressive recruitment drive for mortgage brokers and franchisees, and today that's more prevalent than ever. You know, we've doubled our recruitment activities, which is so important. So the mortgage industry at the moment, the mortgage broker industry at the moment, not just Aussie, but most of us just can't keep up. I mean, lending is going through the roof. So it's really exciting, and it's important that we attract and retain the best people in the business. It just so happens some of the best people have been in industries like transport, in industries like hospitality, where we've come and retrained them to be a professional mortgage broker, and it's working wonderfully.
James Simon, thanks so much for speaking to The Business.
Thank you, Rachel.